Okay, welcome back. Good evening, everyone. Okay, we are starting now. The last time we met, we discussed obtaining an engagement, right? Can anybody hear me? Can anybody hear me?
Good evening. Yes, we can hear you.
Okay, thank you. So the last time we met, we discussed the topic obtaining an engagement, right? When we look at what is obtainable in an audit firm in terms of what? Their day-to-day operation. How do they go about their day-to-day operation? We started with advertising and publicity, where we look at audit firm as a business, because they are anytime you make mention of a business, that means that the business is out to what to make profit. Okay, and we look at advertising and what publicity. How do they advertise to their services to their prospective clients? All of that we look at in the last class. And also, we went further to discuss the how to determine the audit fee. Okay, how to determine the audit fee. And we try to explain what are the conditions or considerations that we look at when you are trying to agree or arrive at the audit fee. We look at all of that in the last class. We also look at tendering, where I said that this is a commercial process widely used by companies, especially large companies, when they want to replace their auditors. Okay, we look at it. I look at all the stages, the initial consideration, where you are going to do a self-evaluation about your about your about your firm. Okay, when you're able to come up with all affirmative, that is everything you ask yourself those questions, you are very sincere with yourself, and you're able to come up with all your answers will be what? Yes, that's what I mean by affirmative. Then you now proceed to compiling your what? Tendering document, okay? That's the tendering process. We are going to carry out a preliminary audit assessment. Then from there, you are going to prepare your brochure. And your brochure will contain all necessary information about your firm, right? Then we now talk about the evaluation, okay? Evaluation. Evaluation of the tender. So you are not going to evaluate the tender, and who is evaluating the tender is the client, prospective client, is one that's going to evaluate the tender based on the following criteria, which were discussed last week. Okay. Then we'll now talk about lowballing. We say lowballing is one of those, is a practice, right? In tendering, where the auditor intentionally reduces the audit fee with the hope of what? Gaining or winning the what? The audit. Okay? So, and there has not been anywhere it has been found that when they use this technique or practice, it has resulted in low quality audit job. It has never been established. So it's still in process. Okay? Then we also look at some conditions, okay, that needs to be agreed, okay, before the letter of engagement is signed. We look at all of that last week. We went on to look at the objective of the, what's it called now? The letter of engagement. What does it stand for? Okay, we look at all of that the last time. We look at the content of the audit engagement letter. We look at in a situation where there is an unpaid fees. We look at confidentiality, we look at defamation in the last class, right? We look at joint auditor, and we'll talk about vacancy. When there's a vacancy, maybe suddenly the appointed auditor suddenly becomes incapacitated. How do you go about it? We talk about transfer of books and paper. We want us to look at if there's a case for additional work, what needs to be done, right? Then we look at appointment of an auditor, and we look at duties and powers of an auditor, as well as remuneration of the auditor, removal of an auditor, and resignation of an auditor. Okay? I think that was where we stopped last week. Am I correct? Is there anybody in the house? Am I correct?
Just joining today, sir.
Okay, for those that joined last, that were in the last class, that was 2 weeks ago. Am I correct?
Yes, sir, you are.
Thank you very much. So that's why, for those that are just joining, that's why I gave an overview of what we did last class, so that I will not just start today's topic just like that. I need to give you like a summary of what we did last time. And that was what I've done now. So you have not missed anything. The material has been shared, okay? In fact, I just shared the complete material on the platform this evening. So, and the material contains all the chapters. There are 14 chapters at the skills level for audit and assurance, and I've shared the material with us, okay? So after the class, you can download it for your own personal use, okay? So with that said, let's go to today's topic. Today's topic, we are going to be looking at what? Chapter 5. And chapter 5 is talking about audit planning and risk assessment. Audit planning and risk assessment. That is what we are going to be looking at, okay? Now, if you look at this very well, you see that this is like the next stage after the engagement has been what? Consummated, after the letter of engagement has been signed and has been shared to the client, okay? After the client has received the letter of engagement, the next thing for the auditor to do is to commence work, okay? So he commences work by developing his audit strategy. All right, he commences work by developing his what? Audit strategy. So in his audit strategy, we have what we call the what? The audit plan. In the audit strategy, we have what we call what? The audit plan. Okay? So the strategy is more like the overview of everything. I can define audit strategy as the all the planning decisions the auditor will take or will make during the audit engagement. All the planning decisions the auditor will take or make during the what? Audit engagement. That is the audit strategy. It contains all the strategy, all the approaches that it's going to use. So when I said that, that is the audit plan is a subset of what? The audit strategy. Okay? So let's look at what audit plan, because this class essentially talks about what? Audit plan. Okay? So what does the audit plan? What does it mean? So audit plan is a document, okay, that shows the course of action of how each of the specific areas of the audit will be carried out. It's a document that shows the course of action of how each aspect of the audit engagement will be what? Will be performed. That is the audit plan. So what that means is that in each aspect of the audit strategy, right? Because we are talking about auditing of financial statements, okay? We are talking about what? Auditing of financial statements. And we are talking about auditing of financial statements. What that implies is that we are talking about the various components, okay, that makes up the what? The financial statement. So for instance, we are going to look at the statement of financial position. So in your statement of financial position, you divided into 4 parts, right? You have the equity, share capital, or equity and shares, right? The next one, you have the what? Liability. The next one, you have the non-current assets. The next one, you have the current assets, okay? So each of these are various sections of the statement of financial position. So the auditor will develop audit plan, okay, for each of these aspects. That is what we mean. That's what I mean by each section of the what? Of the audit engagement. The same thing for what? If we're talking about statement of finance, statement of profit or loss, other comprehensive income, it's going to develop audit plan for sales. It's going to develop audit plan for purchases. It's going to develop audit plan for expenses. And it's going to develop audit plan for if there is anything like returns, okay, or anything that has to do with comprehensive income, okay, extraordinary item, all of it's going to develop audit plan for each of these aspects. So that's what makes the audit plan. Okay, that's what makes what the audit plan. Okay, so one thing you need to also note is that the audit plan is iterative. It keeps what? It keeps changing. You can start by saying that you want to do this, but at the end of the day, because of one circumstance or the other, you might need to extend it. Okay, there are certain things, there might be some audit procedure that you never thought of, but because you have started, it becomes expedient that you need to carry out those audit procedures to be able to substantiate the audit evidence you have obtained, right? So in that instance, there may be need for what? Additional audit procedure, which were not thought of at the initial stage. So that is why I said that the audit plan keeps changing until when the audit engagement is completed. You will keep changing the audit plan until when the audit engagement is completed. I hope that is clear. So the audit plan also needs to be prepared in such a way that it achieves its what? Its objective. What is the objective? To ensure that the audit objective, or to ensure that the audit of the financial statement is carried out in an efficient and effective manner. That is the main essence of the what? The audit plan. Okay? So the next thing to ask ourselves now is that what are the content, or what does the audit plan contain? What does the audit plan contain? Now, these are some of the information that the audit plan contains. Number one, the audit plan set out to answer these three main questions. Number one, who will perform the audit work? That is the staff. How many audit staff do you need? Okay. When will the work be done? How long, the duration of the work? Thirdly, what work is to be done? That is, you need to focus on key aspects of the business, okay? And before you drop your audit plan, you must have carried out what we call a preliminary audit assessment, because that's going to go a long way in assisting the auditor, okay, to have a better understanding of how the business operates. Okay, so that's the content. Okay, now I talked about the auditor need to have a good understanding or get understanding of the client business, because you cannot audit what you don't understand. Okay, so we look at audit plan and what? Risk assessment. Okay, now both of them go hand in hand. The main essence of the audit plan is to ensure that there are no material misstatements. Okay, so that the plan should ensure that all material misstatements are identified, they are what? They are investigated or they are audited. That is the essence. Okay, so what we need to do is that for the auditor to be able to carry out the audit, he must be able to assess the key risk areas of the business. He must be able to assess what? The key risk areas of the what? Of the business or of the client's business, okay? Because that's going to go a long way in affecting his what? His audit plan. Because once he's able to understudy the key areas of the business, he's able to know the amount of audit work to be performed, be able to size it up, estimate it, and say, oh, this is how much of work that will be done. Okay. The next thing that the risk assessment we do is knowledge we do is the fact that the areas on which the auditor will focus his attention. Because he has conducted what we call a preliminary audit risk assessment. And to refresh our memory, what is the preliminary audit risk assessment? This is an assessment that is done, okay, prior to the commencement of the what? Of the audit. Okay, so that assessment is done such that at the end of the day, when the client appoint or nominate the prospective auditor, right? His knowledge, the preliminary risk assessment, okay? Audit risk assessment will now come handy in helping the auditor to, plan his engagement in an efficient and effective manner, okay? So that is what we mean by that. Is there any question? Is there any comment? Is there any observation? Is there any comment? Question? Observation? We are all good, right? All right. And we assume that we are all good. So, what do we do now? We look at I believe that we are all clear, right? Let's go to the next area. Let's look at what? Professional skepticism. What does it mean? Now, when the auditor is drawing up his audit plan, right, it is expected that the auditor should have an attitude of what? Professional skepticism. What does that mean? What it means is, as an auditor, you must have in the back of your mind that sometimes the information provided to you by your client might not be what? Might not be accurate, might not be complete. So you must have in the back of your mind. So that is why the auditor must have what? An attitude of what? Professional skepticism. Because it is believed when you have that attitude, it will make you to be able to carry out due care, skill, and diligence while performing your audit engagement. I take it again. If you have an attitude of what? Professional skepticism, is going to make the auditor, okay, to exercise due care, skill, and what? Diligence in the course of performing the work. But it's going to go all out to ensure that every information that is presented, they are what? They are verified and they are what? They are validated. Because auditors believe in what? Documentary evidence. We are going to look at that in chapter 6. Okay? I hope that is clear. So what do we mean? So in principle, what do we mean by professional skills? I've told us, I've explained to us what we mean by professional skills. So what does it mean? What's the definition in principle? The principle is an attitude that includes a questioning mind to be able to ask questions. Okay, being alert to the condition which may indicate possible misstatement due to error or fraud, and a critical assessment of audit evidence. Okay, so what that means is that there's possibility that you requested for A to 10, A to Z, and the client brings what? A to Z, but in between, because you are very, very thorough, you are very, very competent, right? You are able to fish out some of those alphabets or those documents that were not provided. Okay, so you're able to sieve it out and told them that these documents are not provided completely. And could you go and brief me or provide me with the correct information? So if the editor does not have an attitude of professional skepticism, the quality of his audit work will be what? Will be very, very poor. It is that attitude of professional skepticism that makes the audit work to be what? To be very, very good. Everybody will see it and say, yes, this work has been thoroughly carried out. Okay? So we go to the next one. I hope everybody understood what I just explained. Okay? We go to the next one. Understanding the entities and its environment. Please, are we together? Are we still following?
Yes, sir.
Yes, yeah.
We're together, sir.
Okay, if you have any question, please, you can stop me at any time so that you can trash the question, right? All right, thank you. So let's continue. Let's look at understanding the entity and its environment. Now, there is an auditing standard called ISA 315 that talks about assessing the risk, okay, of the client business and its environment. So in general, what that is saying here is that as an auditor, you must gain understanding of your client business. You must understand how your client business operates. Okay, that means that even though you are not a staff, but you have a good understanding of how the organization is being managed. Okay, so one of the ways you want, one of the things we want to look at now is that how are we sure, or how do we know that the auditor understands the client environment? Okay, how are we sure the auditor understands what? The client environment. So these are some of the questions you will need to what? To answer. The industry in which the entity operates. So let's say you have a client now that is into what? Dangote. Let's say Dangote Nigeria Limited, right? Or Dangote Group, right? And you want to look at how do you classify Dangote Group, knowing fully well that Dangote Group is what? Is not just an organization. It is a conglomerate because there are different sectors embedded or fused together into the what? Into the group of companies. So we have construction, right? We have oil and gas, we have automobile, right? We have the flour, we have the sugar, we have the salt, we have the cement. Okay, so you can see the divergent sectors where the business operates. All right. So you agree with me that all the one that has to do with Dangote flour, where you have the Dangote spaghetti and the likes, that will come under the FMCG, right? Fast moving consumable goods. I hope you are getting. So if you are able to understudy or understand the industry where the client business operates, it will go a long way in helping the auditor to carry out a good audit work. All right? It's like having a friend now. You say this person is your best friend, but the only thing you know about that your friend is that he comes to school. You don't know his family, you don't know his relative, you don't know his siblings, you don't know anything, and you don't know where he lives. You only meet in the school. I say that person is your best friend. That person cannot be your best friend. If someone is your best friend, that means everything that is as little as knowing his siblings or knowing where he lives will become very, very important or will become a good yardstick to say that you know this person inside out. And the same thing is what we are saying here. Before you can audit a client, you must be able to understudy or understand the sector where he operates. Because each sector have their own guiding principles, regulations, and law. Number two, in course of trying to gain understanding of the client business, the auditor should be able to understand the nature and competence of his management. The nature and competence of what is management. That is the management, the client management. You need to know their level of what? Competence. You need to know the level of what? Competence. Because you cannot, if you cannot assess their competence level, then most of the work you are going to do will be an exercise in futility because you will not be carrying them along. Okay? So you need to test the competence, assess the competence of the client management. Okay. The other thing you also need to know in trying to get an understanding of the client business is to understudy the entity's internal control system. Okay. You need to have an understanding of how the internal control system operates, right from where? Right from the gate to the department. You need to understand what's the flow, what's the workflow. Okay, so you need to understand it. So, for instance, I mentioned at the gate. So, what that implies is that if a staff is expecting a gift or is expecting an order, the first point of call will be at the what? At the gate. And it's expected that once it arrives at the gate, the security personnel also have done what? Take down all necessary information, okay? And do what? And inform the recipient of the what? Of the ordered item. But let's say this was not done and the ordered item was brought into the office and it became what? Lost. They couldn't find it, whether they stole it or they did something to it, but it's no longer in the facility. It becomes very troublesome. It becomes very difficult for the auditor to be able to trace whether these items actually got into the what organization, because there's a weak internal control system that talks about what? Documentation. You need to document everything. There's a saying that once it's not documented, it is not done. If you don't document anything, it is expected or is believed that it has not been what? It has not been done. Okay? The next thing that they will need to know also is the current financial performance. How will he get the current financial performance? When he performed the preliminary audit assessment, he would have obtained draft trial balance. Okay, he will have obtained what? Draft trial balance, or have obtained draft financial statement. So from there, the auditor can know if the company is performing well or not. All right. The other thing I also need is reporting requirements and what? Deadline. So every organization, in the course of trying to understand how a business operates, you need to know if you need to understudy, do they have a reporting line, okay? A reporting requirement and what? Deadline for what? For performing a task, okay? So the other we need to look at the reporting requirement. For instance, what is the workflow for reporting? Who prepares the audit? Who prepares the report? Who reviews the report? Who presents the report to the managing director? All of this must be clearly spelled out. Okay. Another thing that's also needed is the other we need to also confirm if there has been any recent development since the last audit. If there has been what? Any recent development since the what? Since the last audit. So let's say the last time they came to audit the organization, that was in 2023, right? Dollar was around 1,000 naira, okay, to a dollar. Now, 2024, when they came, dollar has gone up as almost like 1,800 to a dollar. Okay, so that could have impacted the business. So it could be that the raw materials that they import, because of the cost of production, okay, that's cost of ordering, cost of keeping, cost of everything that has to do with that particular item, okay. So all the costs, by the time the management summed everything up, they had a meeting and discovered that this is no longer what profitable. So they stopped or they discontinued the production of that particular SKU. SKU means the particular product stock keeping unit. Okay. So that would have been, they would need to report it that yes, last year, 2023, we were still doing very well, we were still importing. But in 2024, because of the executive order, okay, made by the president, that they would start to float the naira. Okay, that was when everything was changed. You understand what I'm saying? So that is a recent development. Another recent development could be that the CFO that worked with the auditor last in 2024 for 2023 account, as of today, has resigned his appointment. So that means the auditor will work with a new CFO. So these are some of the instances that you will discuss under other recent developments. Okay? I hope it's clear. Okay. So as we go on, the risk assessment process will then provide a basis for designing and implementing responses to those assessed risks. So as an auditor, in doing your audit, you will have the method you are going to use or the strategy you are going to use is to use what we call a risk-based approach. When you use a risk-based approach, what that does is that it makes the auditor to focus on what? The key aspects of the what? Of the organization. Okay? We focus on what? The key aspects of the what? Of the organization. So, in the course of assessing the risk in an organization, then it must be clearly stated that the auditor will be able to assess, because the first thing you need to do about risk assessment is to first of all identify the risk. Has the auditor been able to identify the risk? Okay, that's the first thing. The second thing is, has the auditor been able to do what? To manage the risk. Has he been able to manage the risk so that it doesn't go out of what proportion? All right. The next one is the auditor to ask himself, has the risk review? Okay. We need to review the risk assessment again. Then after which is going to what? Draft is what? Audit report. Okay. That is the risk report. After drafting the risk report, is going to do a follow-up report, because the risk report is just a report that shows a summary of everything that has been done in terms of what? Recommendations and observation. So for the auditor to be able to know that whether this thing has been thoroughly checked or closed out, there might be need to do what? A follow-up, to reassess those recommendations to see whether it has been approved, okay, for implementation. All right? I hope we are getting it. Okay, so the next thing we are going to talk about now is talking about what? Risk and uncertainty. Risk and what? Uncertainty. First of all, after we know it's a continuation of what we have discussed, right? So we talk about risk. Risk is what? Anything that can stop an organization or an individual from achieving their set objective. Okay? So risk assessment is very important also in what? In planning. Because the auditor will have focused on all those key risk areas of the business and deploy competent hands to do what? To handle those areas. Okay? So those areas are porous in the sense that when there is a material misstatement, okay, it could be what? It could be very high if it's not properly what? Managed. Okay? If it's not properly managed, it could become what? Something that is what? Very, very high. So what you need to understand here is that risk is what? Is uncertain. Okay? Risk is uncertain. But there is every need to track and manage the risk, whether it's the risk of the business or the risk of the what? Of the staff or individuals. Okay? So what you need to note here is that, as like I said, in the course of audit planning, you have to factor in what? The risk assessment. And what will this do? This is going to assist or to help to identify where risk of misstatement appear to exist and the nature of the risk. You're able to identify, I talk about risk identification. The next one is that when the error should be what? Should be classified as what? Material. Because there are some errors that are not intentional. Those ones can be what? Can be ignored. For instance, right? In a manufacturing setup, we have what we call normal loss and abnormal loss. Normal loss are part of the losses that are quite understandable and can be acceptable. For instance, you might say that, oh, because you are in production, right, there will not be any wastage beyond, let's say, 1% or 2%. So in a whole circle, right? So if we are talking about the whole circle now, we now have the organization now had wastage that is over 10%. So that one is an abnormal what? Is an abnormal loss. So that before that one can be written off, there must be, you must be able to obtain the board's approval, the board of directors approval. Okay. Then another thing is that in the course of carrying out a risk assessment, you'll be able to identify those areas, right, that are very, very challenging to the auditor during the what? During the engagement, because there is high risk of what? Misstatement. Okay? I hope we are together. So those are some of the things you need to know. Then the other thing you also need to also understand with this risk assessment is the fact that as an organization, when the auditor is auditing a client, he must have set his what? Materiality level. He must have set his what? Materiality level. What do you mean by materiality level? So materiality is covered under ISA 320. Okay, International Standard Auditing ISA 320. So what is materiality? So materiality relates to the omission or inclusion of an information that can affect or that will affect the economy decisions of the users of what? The financial information. The omission or inclusion of what? Of an information that will affect the economic decisions of the users of the financial information. So if that information is missing or is not there, there is a way the users of that information will work without it. And if that information is there, it's going to play a key role, okay, in affecting the economic decision of the users of what? The financial statement. Okay? So that is some of the risk that we talked about. Then another thing that we also need to talk about is that all what we have discussing so far has been a what? Audit plan. Now, and I remember I said that the audit plan is a subset of what? The audit strategy, which otherwise called the audit approach. Okay? So in an organization, the auditor can utilize any of these four strategies, any of these four audit strategies. The first one is called the substantive approach. The first one is called what? The substantive approach. This is it here. The substantive approach. What does it mean? This is a strategy where the auditor will test or will check everything. Okay? The auditor will vouch and verify every transaction and every supporting document. Okay? So most times you utilize this approach or strategy when when there is no internal control, when internal control system is what is very weak, and when the company is very, very small. So the auditor will check everything. For instance, example of small companies or small organization is school. Okay, a school. The auditor can afford to check every transaction in a school because it's not much. But no auditor can verify and vouch all transactions that exist in a bank. Let's say a bank like what? First Bank. Because of the time constraint, the auditor cannot vouch and verify every information. So in that instance, it's going to deploy another audit approach. The next one, the next audit strategy, audit approach is what? Is the system-based approach. Now, the system-based approach is basically talking about the internal control system. That is, you must have a what? A strong internal control system. Okay? You must have a what? A strong internal what? Control system, where the internal control system will be the control point, which I normally call the internal control over financial reporting, because if there's a weak internal control, it's going to affect the financial reporting of the what? Of the organization. Okay? So what we are saying here, that's the second one. The third one is called the statement of financial position audit approach. Statement of financial position audit approach. In this instance, the auditor will focus essentially on the statement of financial position itself, right? And it's going to look at all the four components of the statement of financial position, which are what? Equity, liabilities, current assets, non-current assets. The auditor will look at everything. Okay? So that is the third one. And in that third one also, the tools that you use to verify if that has been done is what we call the financial statement assertion. Because financial statement assertion that they use to prepare the what? The financial statement. So what are financial statement assertion? Financial statement assertions are statements made by management explaining that the financial statement presented do not have any misstatement. Financial statement presented do not have any material misstatement. That is what we mean by financial statement assessment or assertion. Financial statement assertion. We are going to look at this in detail in chapter 6, audit evidence and sampling. Okay, and that will come in after this chapter. That will be the next chapter we are going to talk about, because if I start it now, I will be derailing from the main topic. Okay, so it's well explained in the next chapter, which is what? Chapter 6. Then we have another approach, which is the last approach. It's called what? It's called risk-based and business risk approach. And this one combines two approaches, that's business risk and risk-based. Risk-based here means that the auditor will focus on key risk areas of the business. That is what risk-based audit. Okay? And the second one is that the auditor will focus on what? The business risk. The business risk is divided into two. Okay? We have the internal business risk and we have the external business risk. The external business risk are those things that we learned in CSM, PEST, because they are outside the control of the organization. We call them what? External business risk. Example, the PEST, political, economical, sociocultural, technological, environmental, and the last one, legal. So all of these, you cannot change it. You can only work within what you have. Okay? Then we have the internal business risks. These are risks that are within the control of the what? Of the management, of the client management. For instance, high labor turnover. High labor turnover is a problem that dwells with what? With management. If the management is committed to ensuring that there is no labor turnover any longer in their organization, they need to work on their what? On their policy. Okay? You need to do what? You need to work on their policy. And if there are breaches in policy also, is that laws are made for man and not the other way around. Okay? So the laws that are made for men are supposed to be what? To be obeyed and complied with. So when there are infractions, when there are breaches, definitely is going to affect the internal control system, as well as what? The financial reporting, because the financial reporting depends on what? The effectiveness and efficiency of the client's internal control system. So in short, what I'm trying to say is that these four approaches can be utilized all at once where it is applicable. So it is also possible that you utilize two or one of these approaches, depending on which one is applicable to your client management. Okay? I was talking about materiality that time. We can still talk about it here, okay? Because I've talked about it, but there are some aspects that I did not make mention of, and those are the areas I want to focus on. Okay? So I've explained everything, what they have here, okay? So ISA 320 expects the auditor to apply the concept of what? Materiality when planning and performing the audit. So like the audit plan also, the materiality is also set at the planning stage. It is also set at what? The planning stage. And when evaluating the effect of misstatement on the financial statement, then you also need to be mindful of how those misstatements will interpret or will impact the auditor's opinion. So if the misstatements are material, definitely is going to lead to what? Qualified audit report or audit opinion. Okay? So at the planning stage, the auditor must determine materiality for the financial state. I've talked about that before. I'm just reading it out. I've thought about that before. Then, what you need to realize is that we're talking about materiality. We have what we call materiality level, otherwise known as what? Materiality threshold. Materiality level or materiality threshold. We are saying the same thing. What does it mean? The auditor usually, based on the draft trial balance that he receives or draft financial statement that he receives from the client, the auditor is able to compute is what? Is materiality threshold. It's able to do what? Compute is what? Materiality threshold. So what that implies is that the materiality threshold can be attained by considering these three aspects of these financial statements, okay? Or even four. You look at profit before tax, you look at revenue, you look at net assets, and you look at what? Total assets. You look at what? Profit before tax. What that implies is that your profit before tax, what you are driving at is that, let me first of all explain what you mean by that materiality threshold. So when the auditor is leaving his office, based on the information he has obtained from the client in terms of what the draft financial statement or the draft trial balance, the auditor will determine what will be the materiality threshold. What that implies is that the auditor will be able to determine to what extent is it going to review all the financial information in financial statement. Okay, all the supporting documents, to what extent? So if it's focusing, and this can be achieved by looking at these four areas. First of all is revenue. The auditor will look at revenue. The auditor knows that there should be what? A cap on the revenue. So when you have a revenue, annual revenue of, let's say, 500,000 naira. Okay, I'm just assuming 500,000 naira. Okay, you have 500,000 naira, and you don't want to know what percentage of this revenue is considered material. What that implies is that if there should be what? If he's not able to check which are the ones or what are the ones that he should not bother himself with. So based on the threshold, right, is between 1 and what? 3%. So what is 1% of 500,000? That's 5,000 naira. So what that implies is that as an auditor, once I obtain the revenue ledger or sales ledger, right? Any transaction that is less than 5,000 naira, I will not bother myself checking it because what? It is immaterial. Okay? Because of what? It is what? It is immaterial. 5,000 naira and below in an organization, when it checks the ledger, is immaterial. So you will not bother himself with it. However, there's a caveat here. However, you have to have an understanding that when you aggregate 5,000 naira in 10 places, that is what? 50,000 naira. So it becomes what? Material. So the auditor has that understanding because if somebody wants to perpetrate fraud in an organization, it's not going to play so dumb that it's going to play into the hands of the auditor. So for the auditor to be able to track whether there's a fraud, whether there's a material mistake in financial statement, by the time he utilizes this threshold, of 1%, you're able to determine, okay, I think anything from 5,000 naira can mean immaterial. But we look at other series because while the auditor was leaving his office, for him to be sure that there are no material misstatements, even though I said that it's 5,000 naira, that is the minimum amount, you must be able to get as much as what? 40 samples of transactions above 5,000 naira. If you're not able to get transactions above 40 transactions above 5,000 naira, that means that the auditor cannot confirm that there is no material misstatement in the financial statement. Because it is the sample that is able to get that 40 samples that will testify or that will give you the assurance that, oh, there are no material misstatements in this financial statement. But where that is not done or is not possible, then it means that the auditor cannot conclude that there are no material misstatements in this financial statement. Okay, I hope you are getting it. This area is highly tricky and they normally set questions in this area. That's why you see me, I'm taking time to explain. If it's not clear, please ask me to explain again. All right. So, like I was giving a scenario, we are using any of these metrics for materiality, whether revenue, whether profit before tax, whether net assets, whether total assets, right? We can only use one of them. We cannot use four of them. You can only use what? One of them. If you are going to base your materiality on revenue, or you are going to base your materiality on profit before tax, or you are going to base your materiality on net assets, or you are making your materiality on what? Total assets. Do you understand? So you have to choose one out of these four, not all the four. Okay? So when the auditor is on the field at his client office and is looking at the sales ledger, and it could not obtain 40 samples of what? Transactions above what? 5,000 naira. So it becomes what? Worrisome for the auditor. So what would the auditor do? The auditor would, even before he left his office, right, would have also have what? An attitude of what? Rational skepticism that something might not be right. So he will have planned, he will have another alternative plan called Plan B. That is, what if I'm not able to get those 5,000 transactions above 5,000 naira? What should I do? Because I cannot just generalize or conclude that there are no material mistakes. What should I do? The author will now say that, okay, I use 5,000 naira as the transactions below 5,000 naira as what? As immaterial. Now, let me increase what's it called now? The threshold. Okay, I was using 1% before. Let me now do 0.01%. Okay, that is 0.01%, okay, of 500,000 naira. So that one is what? That is 500. What that means now is that 500, any transaction will do 500 naira, it doesn't, the auditor will not be bothered. When it's above 500, he will see it. So he now checks through and he sees series of transactions above what? 500 naira. So that moment or that time where he reduces his materiality threshold from what is the norm, what is the standard, for him to be able to obtain enough samples. When he reduces it from 1% towards 0.1% of revenue, that process is known as what? Performance materiality. That process is known as what? Performance materiality. Because what that implies is that it was while on the field, during the performance of the audit, that he discovered that the overall materiality threshold was not giving the desired what? Output. So that was why he was able to what? Improvise by reducing the percentage further down from 1% to 0.1%, and he was able to get enough samples. So that moment where he changes the materiality threshold to a particular value from 1% to less than 1%, it is known as what? Performance materiality. It is known as what? Performance materiality. Okay? This is it here. Performance materiality recognizes the fact that if all areas of the audit are carried out to detect all errors or omission under the overall materiality level, that objective could be achieved. But when all the individual immaterial errors or omission are added together, overall materiality could in fact be what? Be breached. So what is performance materiality? Performance materiality is a way of taking the risk into the account and will be set at a lower figure than the overall materiality. There may be one or more performance materiality levels, as the levels could vary by area. I'm just, why I read it out for you also have an understanding of what I just explained. So please, if it's not clear, I can recap. So let me ask again. Is everybody clear with the distinction between performance materiality and overall materiality threshold? Are we all cleared?
Not clear. Not clear, sir.
Which one is not cleared?
That's the difference from the performance materiality. I was lost there.
But do you understand the overall materiality?
Not really, actually.
Are you just joining?
Yes, actually.
You just join now.
No. I've joined from the beginning.
Is there another person that is not clear? Do we have anybody that is not clear with my explanations thus far?
Yes, I think you should take this one more time again so we're able to grab it. So, thank you.
Okay, let me explain it again. I'll start with what? Overall materiality. Overall materiality is part of the audit plan. So we call it overall materiality because it is determined during, or it is determined before the audit commences, because the auditor will have carried out what we call a preliminary audit risk assessment. So he has an understanding of what is the revenue, what is the profit before interest and taxes, what is the asset, okay, what are the equity. The auditor will have been able to determine. And overall materiality is a rule of the thumb. What I mean by rule of the thumb is that it has been in use over the years and it has become what? Acceptable all over or globally. So there are standard metrics that they use, okay, using what? Percentage. Because it is obvious that the auditor might not be able to cover every area of the what? Of the audit. But one thing is certain, if there is an omission or there's an inclusion of an information in the information provided to the users of financial information, it can affect their economic decision. I hope you got it. I hope you got it up to that point. It could affect their what? The economic decision, like when they want to take decision. Okay, for instance, let me give an instance. So there is an understatement of what? Of revenue in the financial statement that was presented, that was audited by the auditor. But the auditor did not detect it. And an investor or a co-owner decided to do what? To invest based on that information. Okay? So in that instance now, what I'm trying to say is that there is an inclusion of an information that was not supposed to be there, because that overstatement ought not to have been there. I hope you get to that point. Now, in a situation where everything was perfect, there is no material misstatement, everything was okay, the investor would also be able to make informed decision based on that information. But you all agree with me that in no time, all those people that took decision where there was an overstatement or understatement of any information in financial statement, in no time, that is going to do what? It's going to impact on the economy decision, because in, let's say, the next 6 months, the economy might start having issues because of the reason of what? Overstatement or what? Understatement of any information in the financial statement. So to avoid that, the audit firm usually set what we call what? Overall materiality level. And in setting the materiality level, they use the metrics when they decide on what? Revenue, point before interest and taxes, equity, and total assets, any one of them. And they will assign what? Percentages to them. What does that percentage mean? Because it is expected that the auditor cannot cover every area because of what? Time constraints. So what are the areas that in case the auditor cannot cover or could not cover it, does it pose any danger? Does it affect the economic decisions of the users of financial statements? And that's where that percentage comes in. 1 to 3% for revenue, okay? Is here. 1 to 3% of revenue. Point before interest and taxes, 3 to 7%. Okay? Equity is 3 to 5%. And total assets is between 1 to 2%. So what that implies is that you are going to use one of them. And I gave an instance that assuming you have 500,000, assuming you have 500,000, you make a valuation with 500,000 per annum. So what that means is that the auditor might not be able to check everything. What would they do? Because from that rule of thumb is between 1% and 3%. So you now say times 0.1. It gets what? 5,000. So his overall maturity level is what? 5,000 naira. What that implies is that any transaction, it checks under what? Under the sales ledger that is below 5,000 naira. He will not bother himself with it. But he has an understanding that there could be a situation whereby they've tried to manipulate the financial statement such that the aggregate of 5,000 naira will become what? Material. Even though 5,000 naira is immaterial. But when you aggregate 5,000 naira in 10 places or 10 times, it becomes 50,000 naira. It becomes what? Material. Is that one cleared, first of all, before I go on to performance? Are we clear with my overall materiality now?
Yes, sir.
Are we cleared?
Yes, sir.
Emmanuel, are we cleared?
Yes, sir. Yes, sir. Yes, yes. I get it now.
Okay.
Thank
Now, let me now go to performance materiality. So, while the editor was stepping out in his office, he has set up with what? He has set out with what? Overall materiality threshold. And he's expected to obtain X amount of what? Samples to confirm that there are no material misstatements. X amount of, let's say supposed to collect like 40 samples of 5,000 naira, transactions above 5,000 naira. But in looking at the financial statements, you could not get everything. You only got 5 or 10. So because he couldn't get the 40, his level of assurance is what? Is not confident enough. Doesn't have that reasonable level of assurance. So what will he do? He will do what? He will improvise. I did 5,000, I couldn't get anything. Let me reduce the threshold. So he reduces it to what? Instead of using 1%, he now use 0.1%. And if you use 0.1%, rather than looking at 5,000 naira, you'll be looking for what? 500 naira. So at a glance, while I was looking at the sales ledger, he was able to pick over 40 transactions that relates to 500 naira. So I now said that instance where he reduces his maturity threshold from the overall materiality to a lower materiality threshold, it is known as what? Performance materiality. Because he got this while performing the what? The audit at the client business. He did the first one, he did it what? At home or in the office. That might be what? That might not be as realistic as the one that he was able to do or was able to get right on the field. Is that clear? Are we all clear with this? Hello, Emanuela, Sunday, are we cleared?
Sorry, let me just say something a little if I
Please
get
go
it.
ahead.
Okay,
Please go
so
ahead.
this performance materiality, if I understand you properly,
Yes.
it says it's a situation where the auditor decide
Mm.
to reduce the is benchmark, that is from the threshold. Let's
Overall
assume.
materiality. Overall
Yes,
materiality.
yes. So the purpose for reducing this, is it that it's actual benchmark for that is the percentage? Is it that is it discovered that the sales, or let's assume the amount he has on that level are much? Is it why he's reducing his threshold?
Less. It's because the sample we're supposed to get, the number of samples we're supposed to get were less.
Okay.
He has programmed himself to get 40. But while he was on the field, he has put it at what? You can only get what? 20.
Okay. That is understandable.
Is that clear now?
That's fine.
Emmanuel, are we cleared?
Yes, thank you.
All right. So because this area is an area that's very tricky. You see the number of minutes I spent clarifying this area is highly, highly technical. Okay. So that's why I took time to explain it. So since we've gotten it, so we can move on. All right. Next one we are going to look at. So we are done with materiality now. Let's go to the next area. Audit risk model. Audit risk model. Okay. Now, what do you mean by, let's look at it before we come to audit risk model, let's define what is audit risk. What is audit risk? Audit risk in CSME, right? We're talking about risk. Risk is what? Anything that prevents the achievement of an objective is a risk. Okay, so what is an audit? Audit is what? To examine financial statement, whether it has been prepared in line with what applicable financial regulatory framework. That's the meaning of audit. We now have audit risk. What that implies is that there is an issue. You cannot verify whether the financial statements are prepared in line with the applicable financial regulatory framework. So in a nutshell, we define audit risk as as a risk that that the auditor could not make appropriate opinion, or the auditor did not make appropriate opinion as regards the what? The financial, as regards is what? The audit report. Okay? As regards what? The audit report. That is, the auditor reaches a wrong conclusion during the what? During the audit. That's another way to put it. So audit risk is that the auditor could not arrive at what? At an appropriate audit opinion or conclusion. That's what we mean by what? Audit risk. Okay? So what does that mean? Let me explain what it means. What I'm saying here is that at any time the auditor goes to work, goes to carry out or performs an audit engagement, there is that possibility that there will be what? Audit risk is always there. The potentiality is always there. Okay? The potentiality is what is always there. Once it's set out to perform an audit engagement, there is that potentiality that it could be what? There could be audit risk. And that is why audit risk is not a big issue. But what the objective of having audit risk is to ensure that the audit risk is brought to an acceptably low level. The objective of audit risk is to ensure that the audit risk itself is brought to an appropriate low level. You cannot eliminate it. That's what I'm trying to say. It cannot be eliminated, but it can be what? It can be managed. That is audit risk. I hope it's clear. Now, what you need to know here is that the audit risk has three main components. There are three main elements of what? Audit risk. There are three main elements of what? Audit risk. What are they? Inherent risk, control risk, and detection risk. Inherent risk, control risk, and what? Detection risk. So what I'm saying here is, when you talk about audit risk, there are three things that makes up the what? The audit risk. Let's take them one after the other. Inherent risk. Inherent risk are risk that by their nature, they are susceptible to what? To manipulation. Inherent risk is the risk that by their nature, the nature of the transactions, the nature of the account balances, the nature of the disclosure, they are what? They are subject to what? Manipulation. Either individually or when they are what? Aggregated. Either individually or when they are what? Aggregated. We call it what? Inherent risk. When they say something is inherent, what does that mean? That thing is what? Is inborn. That thing is what? Is inborn. When something is inherent. For instance, when they say that, oh, this person, the way he's doing things is inherent or something, there's the way they put it, okay? You understand what I'm saying? It means what? It is inborn. So that means by nature has made it so. Okay? Nature has what? Made it so. So what I'm trying to say here is that there are some transactions, there are some account balances that by their nature, they are susceptible to what? To manipulation. So what are those account balances? What are those transactions? The account balances are one. Account balances, where do you find account balances? In the statement of financial position. That's where you have what account balances. So you have the non-current assets, and you have the what? Current assets, and you have the what? The liabilities. All of these are susceptible to what? Manipulation. And I will explain why. Let's start with the first one, non-current assets. If you go back to your IAS 36, IAS 36 talks about what? Impairment, right? So what does impairment say? What does the rule for impairment? IAS 36 says that at least once a year, the organization should test their assets against what? Impairment. What it's literally saying here is that the carrying value that you have, that is the book value you have in financial statement. You have to constantly check it whether it has reduced or not, whether it has reduced or it has increased. Okay? So imagine that an organization did not carry out impairment test over 1 year. What value will they have put as non-current asset? That means whatever value they have put as non-current asset will be what? Misleading, because it will either be lower or what? Or higher. Do you agree with me? Do you all agree with me? Hello?
Yes, sir.
Good. That is one area. So let's go to the current assets. How is it susceptible to manipulation? Let's take a look at inventory. Inventory is covered under IAS 2. Inventory, IAS 2. And it says that when you want to cost inventory, you can only cost inventory using what? These two recommended costing methods. Either it's first in, first out, or weighted average. First in, first out, or what? Weighted average. So let's say, for instance, the management decided to value their inventory using what? Last in, first out. Or decided to use what? Standard costing. Or decided to use what? Base stock. Or base price. If they have used any of these ones that I mentioned that is not recommended by the standard, what that implies is that the financial statements would have been what? Either overstated or what? Understated. Because they did not utilize what? The recommended costing method for what? Inventory. I hope you are getting it. Then the next one, so as you understand what I'm saying, take a look at account receivables or account payables. So I'm looking at both payables and what? Receivables. Payables will arise when a service has been done, has not been paid for. That's payable, right? And in other way around, receivables are, of course, where sales has been made, but revenue has not been what? Generated. You have receivables. So what that implies is that for any management, they can decide to create what? A fictitious accounts payable or a fictitious accounts receivable. They're able to do what? Create what? A fictitious account payable or a fictitious account receivable. All in the essence of what? To achieve an objective. I hope you are getting it. So that's what we mean by manipulation. By their nature, they are prone to what? Manipulation. That's inherent. Let's look at control risk. Control risk is the risk that a misstatement could occur in a transaction, right? And the controls put in place will not be able to what? To detect it. I take it again. Control risk is a risk that misstatement could occur in a transaction, account balances, or disclosure, right? But the controls put in place will fail to do what? To prevent or detect it. Let me give an example of that. So you have an accounting policy that says that for every procurement above 1 million naira, they must accompany and they must attach what? A LPO, local purchase order. But you now discover that while looking at the purchase ledger or purchase schedule, more than 20 procurements were above 1 million naira, and there was no LPO attached to those transactions. So what does that mean? What that implies is that they've not complied with the laid down rules. That is, the control put in place has not been what? Effective. So we call it what? A control risk. Okay? We call it what? A control risk. I hope you get it. We call it what? A control risk. Then the last one is called what? Detection risk. Detection risk. What's detection risk? This risk occurs when the procedures performed by the auditor, okay, did fail to achieve the audit objective. These are risks that occur. These are risks that occur because the audit test or procedure performed could not achieve the audit objective. We call it what? Detection risk. We call it what? Detection risk. Okay? So let me give an instance. Now, the other two that we have discussed, control risk, the other two that we have discussed, control risk and inherent risk. Those ones are outside the control of the auditor. Okay? Because the first one is the nature of the transaction. The other one is control. Who sets the control? The management. So also outside the control, it's outside the domain of the auditor. But this last one, detection risk, is the auditor is fully responsible. The external auditor, excuse me, the external auditor is what? Is fully responsible. So what does that mean? What can make detection risk to be what? To be very, very low or make it high. Now, when the auditor does not have the competence to carry out the audit, when the auditor does not have the competence to carry out the audit, that he does not understand the audit, detection risk will be what? Will be very, very high. Detection risk will be what? Will be very, very high, because that means that, the detection will be very, very low. That means that he does not have an understanding. So he cannot even tell whether things are done right or not. So the detection risk will be very, very low. Okay? I hope you understand what I'm saying. But when the auditor is proficient, the auditor knows what he's doing, the detection risk will be very, very high, because he has the understanding of how the business operates. So he understands when things are not done rightly. So when the auditor does not have the knowledge, detection risk is what? Is very, very low. It cannot detect anything. It's like when you have cold, when you have catarrh, you cannot smell anything. But when your nose is clear, when you are out of cold, you don't have catarrh, you can perceive any aroma. It's the same thing. You understand what I'm saying now? That is detection risk. Now, the relationship between these three components of risk, that is inherent risk, control risk, and detection risk, is known as what? The audit risk model. The relationship between the inherent risk, control risk, and detection risk is known as what? The audit risk model. Okay? So let me further explain. The inherent risk and control risk, they go in the same direction. If inherent risk is high, control risk is also what? Very, very high. They go in the same direction. However, when inherent and control risks are high, detection risk is usually low. Okay? And when detection risks are low, or when detection risks are high, inherent and control risks are what? Are low. So they go in opposite direction. So that relationship between inherent risk, control risk, and detection risk, trying to ensure that the audit risk is always at the acceptably low level. That relationship that exists between these three risks are what is known as what? The audit risk model. Are we together? So that's what it means. Audit risk model. Any
Yes,
question? Yes, I can hear you. Please ask your question.
Sir, my question is among the three risk model.
No, it's
Which
just
one?
one risk model. Sorry, sir.
Okay,
We
yeah.
have
Among the types, that is inherent
among the
risk
components
detection.
of the audit
Among
risk
the
model.
okay. Among the components,
Yes,
which
I will
one
see.
should an auditor pay more attention to?
The one that is within his control, detection risk.
Okay.
The one that is within his control is detection risk. For instance, let me give an example. You understand what I'm saying? There is a robbery in an estate, and someone lives in that estate. That means the estate has a main gate, and somebody lives in that estate. He has his own gates to his own apartment. Okay? So there are two gates now. The gate to his own personal apartment, okay? And the second one, the gate to the estate. Which one should be priority to the resident, the owner of the flat? Mr. Joseph,
Sir,
which one should be more important to the resident? Both of
I
them are
think
important. Which one is more important?
the main gate,
Which main gate?
Get to his
as
own.
in get to his own house or
Uh-huh.
compound rather.
Because if his own gate is secured, even if they break into the main gate, the main entrance gate to the estate, they won't be able to have access to his own house. Do you agree with me?
Yes, sir.
So that is why detection risk is the one that the auditor should focus on. Because even if he doesn't understand that he has a detection risk, or detection risk is very low, how will he even understand when you talk about inherent risk and control risk? Do you understand, sir?
Yes, sir. Yes, sir.
So that is the answer to your question.
Okay, thank you, sir.
Any other question? It's a pleasure. Any other question? Any other question? Are we good?
We are good, sir. But, so if I understand this properly,
Yes, sir. Yes, sir.
it means all these elements of audit risks, the
Mm.
auditor cannot make appropriate opinion over them. Is that correct, sir?
No, it's not correct.
Okay.
What you need to say is this: audit risk is the risk that auditor will make an inappropriate audit opinion. Audit risk is the risk that the auditor will make an inappropriate opinion. Because the three components, inherent risk, control risk, and detection risk, they are all part of the audit risk.
Okay.
Is that clear, sir, Mr. Sunday?
Yes, yes.
Can we proceed?
Can proceed, sir.
Okay, thank you. So let's go to another area or another aspect. It's called what? Fraud and error. Fraud and error. Fraud. There's a thin line between fraud and error, right? So error is an unintentional mistake. Error is an unintentional mistake. Why fraud is an intentional act, okay? It's an intentional act that may involve fraudulent financial reporting or misappropriation of funds or assets. Fraudulent financial reporting or misappropriation of funds or what? Or assets. So that's the difference between the two. One is intentional, the other one is unintentional. Okay? And according to fraud, is covered under ISA 240. ISA 240 explains that there are two types of what? Fraud. We have fraudulent financial reporting, and we have the second one, which is what? The what's it called now? I made mention of it that time. When financial reporting or what? Misappropriation of assets. We have fraudulent financial reporting or misappropriation of what? Assets. Those are the two types that's recognized under the ISA 240. 240 is on what? Fraud. So when you talk about fraudulent financial report, what does it include? What does it entail? It includes forging or forgery, alteration of accounting records or supporting documentation, which form the basis for the financial statement. Another example, misrepresenting or intentionally omitting events or transactions from the financial statement is a deliberate act. All right. Another one, intentional misapplication of accounting principle. When they intentionally misapply the accounting principles, we have a golden principle that for every debit entry, there's corresponding credit entry. What that implies is that assets always have a debit balance. But if somebody now decides to give assets a credit balance, what is that person saying? That person is trying to do what? He's trying to contravene the golden principle of accounting. Because assets supposed to have a debit balance, not a credit balance. So if that is done intentionally, that is what they are trying to explain in that regard. So, fraudulent financial reporting usually involves management overrides of what control. What do you mean by management override of control? The management are the ones that put this is usually by the person at the helm of affairs, the person that sets the controls in place, decide to do what? Set it aside or decide to push it aside to be able to achieve his own selfish interest or objective. So you put a control in place and say that, oh, for every transaction, for every payment, they must have the approval of the head of account or CFO. But when it comes to your own, say, no, don't give to CFO side. Just go and pay my money. I need my money now, 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 now. That person has done. He says, but sir, let's do it now. You are the one that gave the policy now. The person now says that when you start your own company, or when you own your own, when you establish your own company, you can be doing anything you want to do there. So if that is an instance, right? That's an example of what? Overriding of controls. The second type of fraud is called misappropriation of what? Assets. And that includes what? Embezzling receipts. Embezzling what? Receipts. So what that means is that money that's supposed to, a customer buys company's products. And rather than for the sales rep to give the customer the company's account number, he gave the customer his own personal account number. That is embezzling receipt. Okay? That's what we call what? Embezzling what? Receipt. Diverting funds to personal accounts. Another example of fraudulent, another example of misappropriation of assets is what? Stealing physical assets. Stealing what? Physical assets. Some store officers, okay, they usually steal store items because they are the ones in charge. They usually believe that nobody will get to know. Okay. Another example is what? Selling trade secrets to a competitor. Trade secrets, for instance, the makers of Coca-Cola, there's a trade secret for the formula, the API, the active pharmaceutical ingredients that they use to make a Coca-Cola, that secret formula, nobody knows. And that's why you see that if you like, taste all the Coca-Cola drinks you have, the likes of Big Cola, the likes of Biggie Cola, the likes of any cola, American Cola, all of them, Pop Cola, all of them, take Pepsi, take all of them. They are not the same and they can never be the same as what the Coca-Cola. So let's say, and I was going to understand that this trade secret is locked up in a safe that nobody, the person that owns it, maybe one or two people have access to that place. So imagine somebody was fortunate to get to the trade secrets or to get the trade secrets, the formula for making Coca-Cola, and try to sell it to Pepsi. You know that Pepsi will what? Coca-Cola will die and Pepsi what? Will take over. That's what we mean, okay? That's what we mean. Then another example of misappropriation of asset is using an entity's asset for personal use. So you are given an official car. The official car is to commute you from your house to your office and back home. But what you do as the owner of the car or the person that the car has been given to is that the car brings you to office, and between 9 and 4 p.m., 9 a.m. and 4 p.m., you use the car for what? Uber services or boat services or in-drive. When whoever does that is using what? Is performing what we call using an entity's asset for personal use. Or you are the fleet manager, you are the one in charge of the company's fleet. And on the weekend, on a particular weekend, one of your daughters or one of your cousins or one of your relatives wanted to get married. Instead of you to say that you don't have any car, you are the one that said that don't worry, I'll release 5 cars for my company to carry the groom and the bride and family to and through the church. And by Monday, before they come and see anything, all the cars are parked in the office. That's an example of using an entity's asset for personal use. Okay? So what does the law say? The ISA 240. ISA 240 requires the auditor to perform the following procedure to identify the risk of material misstatements due to fraud. So what you need to have at the back of your mind, there is what we call audit procedures. If you don't follow those procedures, you're not able to achieve the audit objective. Because auditing is what is scientific. If you go step by step, you are going to achieve the result. And that is what you need to know as ICAN students. When they ask you audit procedure, you must be able to remember everything, everyone, the way it is arranged, you must put it in that order. It will be suicidal for you to ask a question on audit procedure and you don't know the arrangement or how the procedures are arranged. You now decide to arrange it haphazardly. I'm sorry, the examiner will be very happy with you. You have made his work easier. You just cross it and give the person 0 and move on. So you need to understand that anytime you have an exam and the requirement entails audit procedure, please make sure you have an understanding of the audit procedure. If there are 10, you only remember 7. It's better than for you to remember 3, and the three that you put down are not in the order it's supposed to have been arranged. That's what I'm telling you. That's just somebody you finish audit and say that, oh, I got 10, I got 500. And if you remember the day you wrote the exam, all the booklets were filled with what? With answers. These are some of the reasons. So you should be able to arrange the procedure in the correct order. If you miss any step, the examiner will penalize you. Okay? So when there is fraud, what are the procedures the auditor needs to do? That's what we are looking at now. Number 1, the auditor should make inquiries from management in respect to the assessment of the risk of material fraud. Okay? The auditor should do what? Make inquiries of management in respect to the what? The assessment of the risk of what? Material fraud. Then you also need to ask in respect of what? The process in place for identifying and responding to the risk of fraud. What process do we have in place in case there is fraud? Then another one, any specific risk to fraud, any specific risk of fraud identified or likely to exist. Any specific risk of fraud identified or likely to what? To exist. Then, still under the first one, any communication within the entity in respect of what? Fraud. For instance, whether there is a policy, okay, that specifically explains why fraud is not allowed, okay? That there is a policy that says that the organization disallow or does not permit what? Fraud, okay? The auditor will ask all these questions because if there is no deterrent on ground, then it's possible that you will not be able to achieve the, not be able to detect the fraud. Then the second question you need to ask us, the second procedure is to make inquiries of management and others within the entity as to whether they have any knowledge of any actual suspected or alleged fraud and to obtain view about the risk of fraud. Sometimes you have asked the management, you need to ask every other staff whether they have come across uh, an actual fraud, a suspected fraud, or an alleged fraud. Then thirdly, the third procedure is evaluate any unusual or unexpected relationship. Evaluate any unusual or unexpected relationship identified in performing analytical review procedure. What that implies is that if you look at the ratio, analytical procedure is looking at what? The possible relationship between financial and non-financial data, of which ratio is a part. Ratios are key financial indicators. You can tell whether the company is under threat of going concern. You can tell whether there is what things are not right. Why? Because you have comparative figure, the previous year and the year under review. Okay? The next procedure, evaluate information obtained from other risk assessment procedure to see if there is any risk factor, if there's any risk factor it represents. Okay? What this one means is that, yes, you're asking questions from the users, from the staff, but have you obtained information from, let's say, from the customer or from the supplier? They now marry those information together to now be able to have something to work on. Okay? So that's what they mean by, what do you understand by risk or fraud risk factors? That might be what? The need to meet the expectation of the third party. For instance, the entity is trying to obtain additional finance. So like what that implies is, like what I read in social media yesterday, a lawyer utilized what? A fake house document to obtain a loan from a microfinance bank. You understand what I'm saying? I think he owns a pure water factory and he needed money. He doesn't have any assets. So he used a fake house address or house information to obtain a loan from the bank. She's a lady. Okay. Another thing we mean by fraud factor, fraud risk factor is what? Management being remunerated via profit-related bonuses. So what that implies is that when the management knows that they only receive bonus when they make profit, what will they do? They always doctor the report to show that they make profit altogether, so that the bonuses can continuously what? Flow. So that they will continue to receive and enjoy the, what do we call it? The bonuses. An ineffective control environment. Okay? So what that means is that there are no adequate controls in place that could give rise to what we call fraud risk factor. Okay? The next one, also under the fraud risk factor, the entity's profitability being under threat. Okay? So what that implies is that, let's say there is a threat, you have two competitors, right? And the producer, the other one wants to assign the other person. So what will the other person do? The other person will now go and perpetrate one fraud or fraudulent transaction just to make that other party to be what? To be weak. Okay? Then next one, another fraud risk factor. Low morale among staff or poor communication and or enforcement of ethical standard by management. So when the staff are not happy, for instance, they've not paid their salary as at second week of a new month, the staff might tend to what? Perpetrate fraud just to augment the 2 weeks delay of salary payment. All right? Then you have opportunity to misappropriate assets. Okay? So what that means is, for example, large amounts of cash held or processed or highly portable or valuable in inventory. So, for instance, the storekeeper, he has access to everything in the store. He can decide to pick one thing at a time and he will not get to know until maybe after a while. Okay? Also, when there's a poor internal control over assets, for instance, you allow one person to be doing the job of 5 people. You allow one person to be doing the work of what? Over 5 people. Power corrupts, absolute power corrupts absolutely. So the person will become what? The person can perpetrate fraud. Okay? The person can perpetrate fraud. Remember this former Super Cup, Abba Kyari, that has been able to bring down so many notorious criminals. You know, at some point, the power, he usurped the power, he has so much power because he's the one doing so many things, doing everything at the same time. And that was what led to his downfall when he was arrested. Okay? Do you understand what I'm saying? So that's what we mean by that. Okay. So after you have looked at the ISA 240, right? There is also a need to understand that there are risks of material misstatement due to fraud that the auditor must be able to what? Design his audit procedure such that he's able to what? Detect fraud. There's another standard that says that the design the auditor should design and perform further audit procedure to address areas of what? Fraud. To address what? Areas of what? Fraud. Okay? So if an external auditor discovers fraud, it must be reported to an appropriate level of management as soon as practicable. It must also consider whether there is any statutory duty to report to the authorities. So what this one is saying here is that when external auditor detects fraud, the first thing he needs to know is to look at what level of management is supposed to report the fraudulent activities to. Then two, we need to also note whether it is needed, it is compulsory to report to the law enforcement agency. For instance, if there's a fraud in a bank, the bank we report the matter to what? To the police. Okay? They report the matter to the police. Right? But in some organization, when there is fraud, if the law does not compel them to report to the law enforcement, then nobody will get to know. Okay? That is that you need to know about fraud. Any question? Any question? Any comment? Any observation? Are we good? Okay. I want to believe that we are all good with this. So let's go to the next section. Auditing of not-for-profit organization. Auditing not-for-profit organization. These are the NGOs, okay? These are the NGOs, right? So how do you audit the NGO? That's what we want to look at now, all right? So some of the steps are similar to when you audit a business or a company, right? So for every audit, there must be what? There must be a plan, audit plan, okay? And in the plan, it should have what? The objective and scope of the work. What do you want to achieve? And to what extent do they want to go about it? Two, still under planning, any local regulation that apply. For instance, HAMA applies to every company, every business in Nigeria. Okay? Still under planning, the environment in which the organization operates. Okay, you need to know the environment. Is it a computer-based environment or is it a uh, manual environment? Okay. The next one, still under the planning, the form and content of the final financial statement and the audit opinion. And lastly, key audit areas, including what risk. So all of these are factored in during what? During audit planning. The second thing that is also considered in auditing not-for-profit making organization is the risk. Okay, you need to carry out an audit risk analysis under the usual heading of inherent risk, control risk, and detection risk. Inherent risk, control risk, and what? Detection risk. Okay? Then, still under the risk, you look at inherent risk reflecting in nature of the entities. Okay? Nature of the entities, activities, and its what? Environment. You also look at in fact, you're going to make use of the three components of the audit risk. You're going to look at the control risk to look whether the internal control system is weak or strong. Then lastly, the detection risk. You need to look at that the risk that the auditor will what may fail. The auditor will what may fail to what to identify any material misstatement. Okay, so that is what you do under plan. The under risk. Then the third one is called what? Internal control. So the auditor will carry out the audit plan in such a way that it will cover areas under internal control that relates to segregation of duties, okay, authorization of spending, cash control, control over income, okay. Especially when you have an NGO, the donation. Somebody should be in charge of the donation to account for it, cash collection, membership, membership fee, and grants. These are areas that are conduit pipe for what? For embezzlement. Okay? They are conduit pipe for embezzlement. Areas such as what? Donation, cash collection, membership fees, and what? And grants. Then they use what was the fund or the grant used for? Okay? Some of the donors, right? They ensure that whenever they give money, the money is utilized for that particular purpose. If the money is not utilized for that particular purpose, the person will not be able, the person will forfeit, we have to forfeit that donor because the donor agency will no longer provide money because the money has not been put to what? To good use. Okay? The money has not been put to what? To good use. The another thing that is also important, which is similar to what you have in the business um, organization, is the audit evidence. Okay? For the not-for-profit organization, obtaining audit evidence is always a challenge. Okay? Because they do not keep proper books of accounts and there's a weak internal control system. There's no segregation of duty. Okay? There's no segregation of duty. So because of this, the auditor will carry out 100% check, which we call what? The substantive testing audit approach. All right? So the auditor will also might find it very difficult to ascertain if the money has been what? Has been diverted for personal use. For personal use. At the end of the day, the auditor will do what? We write a report. The auditor will write a report. All right. The audit report is similar to what we have when you audit a what? A business organization. The auditor is going to write a report, and the format of that report is as what is obtained or what is obtainable in an audit of a business organization. So you start with a title, then it has recipients or addressee to the report. He has the opinion, based on opinion, it has the other information, okay, that are contained in the audit report. So that is what that is meant to do. All right. Any questions so far? I know that it's getting late, and I can see that some of us have already hibernated. Any question before we proceed? Any question? Any comments? Any
No, sir.
observation? Okay, so let's continue. Let's wrap up. Okay, we'll try and look at the question. So let's look at the last section, which is what? The public sector audit. Public sector audit is different from not-for-profit organization. Okay, so the public sector, what we are saying is they are looking at the ministries, departments, and what? Agencies. Okay, so what we are saying here is that if you want to audit public sector, you're expected to make use of what we call quasi-autonomous non-governmental organization. Okay? We call them what? Quasi-autonomous non-governmental organization. Okay? So what do they do? Let me give you an instance of what these quangos, what they do. For instance, in Nigeria, we have some of them. They are quasi-autonomous non-governmental organization. Example is SERAP. SERAP. You know the SERAP people. SERAP. Social Economic for Accountability Project. Social Economic responsibility for accountability project, SERAP. You have the budget. The SERAP and budget, what they do is that they help to track government spending, if the money has been religiously utilized or the money has been embezzled. And that's why they always fight the federal government. They're like the opposition. They always fight the federal government. Okay? So because they are quasi-autonomous, means that they are non-governmental organizations. They don't have any affiliation with government. They don't have any subvention from the government. Okay? So what we are saying, what we are saying here is that for most of those public sector or audit of public sector, right? The principle of an independent audit for a public sector entity performed in accordance with ISA are the same as any other audit performed in accordance with ISA. The key difference is the nature of the underlying entity being audited, which will impact audit risk and audit approach. So that is all you need to know about what? Audit planning and risk assessment. Any question? Any question? Any comments? Any observation? We are good, right?
Yes, sir.
Thank you. Okay. So let me see if there's any question on this. Okay. You can quickly look at it and we call it a wrap. I'm trying to see, I'm looking at the checking through the materials that I have here. I'm trying to see if there is any question. Just a minute. Okay, so I've seen a question and I've already sent that question to us in the previous class. Or you have it in it's November 2017, question number 1. All right, let me share it with us before we go. This is the question. I hope we can see my screen. That's the question. The first question, November 2017. And look at it, it's straightforward. International standard on auditing, ISA 315. This with the auditor's responsibility to identify and assess the risk of material misstatement in the financial statement through understanding the entities and its environment, including the entity's internal control. Required. Explain the term audit risk. Explain the term audit risk. This one is simple now. I've explained it severally today or tonight. Audit risk is what? That is the risk that auditor will give an inappropriate audit opinion. Number 2, identify and explain the key elements of audit risk. What are the key elements of audit risk? Inherent risk, control risk, and what? Detection risk. You're not going to explain them one by one. You understand? You have to look at it. These 2 questions are related to what we did today. Okay? Another one, the third one is also related. Explain why the auditor needs to understand the entity's internal control as part of the audit process. They're able to know if there are many reasons, right? One of the reasons is to be able to know which areas is going to focus on, the key areas of the business, okay? It's going to help him. He's going to know which area is going to deploy more staff or competent staff to go and handle. These are many of them. So let's look at how it's done because of our time. Let's go to the answer. Question number 1. Okay, we have looked at it. I hope we are still together. So this is it. The first one said, what is audit risk? Okay, what is audit risk? Audit risk is the risk that auditor reaches an inappropriate opinion or wrong conclusion on the area under risk. You can see that is what it means. All right. Then they now ask for the second one. What is in the post? They said audit risk model is represented by that formula. That's component of the audit risk. You now have this one. You now explain what you mean by inherent risk, which I've explained before to us. You also explain your what? Your control risk. Your inherent risk is the susceptibility of an assertion about a class of transaction, account balance, or disclosure to a misstatement that could be material, either individually or when aggregated with other misstatements, okay, before considerations of any related control. All right, you've seen it, right? The next one is control risk. Control is the risk that a misstatement that could occur in an assertion about a class of transaction, account balance, or disclosure, and which could be material, either individually or when aggregated with other misstatements, will not be prevented or detected or corrected on a timely basis by the entity's internal control system. All right? So you've seen it, right? So we go to detection risk. It's a risk that the procedures performed by the auditor to reduce audit risk to an acceptably low level will not detect a material, a misstatement that exists and could be material, either individually or when aggregated with other misstatements. It is the risk that the audit testing procedures will fail to detect a misstatement in a transaction or in an account balance. Okay? That's the test. Then the next one. How will the auditor, they say, talk about internal control. Why does the auditor need to understand the internal control, how they're acting in this particular area, right? So these are some of the reasons why the auditor needs to understand internal control. One, to identify controls that are relevant to the audit, okay? Although the entity's system of internal control is made up of various controls designed to achieve reliability of financial reporting, effectiveness and efficiency of operations, and compliance with applicable laws and regulations. Not all the controls may be relevant in addressing the risks associated by the auditor. He therefore needs to understand the controls with a view to identify the ones that are relevant to the audit. Okay, second one, to evaluate the design, implementation, and operating effectiveness of the relevant controls, whether the controls have been properly designed, implemented, and operated effectively throughout the period of intended reliance. Now, our next one, the editor's understanding of internal control will enable him determine the controls and will also enable him determine the extent of substantive procedures to be performed. Okay, in addressing the risk identified. The next one, appropriate understanding of the internal control by the editor helps to determine the type of audit opinion. Okay. The next one, knowledge of the entity's internal control is a major part of the knowledge of the client and environment, which assists the auditor determine the audit strategy. Okay. I hope all these things are straightforward as is contained here. Okay. I hope you are straightforward. You understand what I've said. Okay. So we've been able to look at that particular question, right? You can see again, if you look at question number 3, you still talk about audit risk again. You can see it. They still make mention of what? Audit risk here again. Okay? And see that this, so that means that if you don't understand all this audit risk, and you are the one, you attended this particular exam, this particular diet, right? Some of the students that don't understand audit risk will find it difficult to answer questions because more than 2 questions here are relating to what audit risk. So that is why you cannot predict what the examiner will set as questions. But one thing that is constant is that you should be able to read all the chapters, okay? And be able to be ready for any question from any chapter to be able to come out in flying colors. Okay. So that is for that. I'm trying to see if I can see another question. Trying to see if there's another question. Okay, there's another question, question number 6. Is another question that relates to fraud. They say, according to the National Standard on Auditing, ISA 240, the primary responsibility for the prevention and detection of fraud rests with those charged with governance of the entity and management. It's important that management, with the oversight of those charged with governance, place a strong emphasis on fraud prevention, which may reduce opportunities for fraud to take place, and fraud deterrence, which would persuade individuals not to commit fraud. So explain the 2 types of fraud as identified in ISA 240. What are the 2 types of fraud? Financial statement, financial reporting fraud, and what? What's the second one? Misappropriation of what? Assets.
Yes.
Thank you very much. Thank you very much. Then the second one, they ask us, destroy the procedure performed by auditor to identify risk of material misstatement due to fraud. All those procedures that we look at before, we're going to still look at them now. And thirdly, state 4 fraud risk factors. We have also looked at those ones too. So this is question number 6, right? Let's go to that particular, let's go to the answer and see if we are right, because I know that we've done if you look at this exact one, you can see that I see they lifted it from the material that we are using. So that is it. So you have to understand your material very well. It's not a matter of you committing it, cramming it. It's for you to understand it. Once you have an understanding, I believe that it's going to be easy. All right. That's why I say that we are not rushing. We are just taking one step at a time to be sure that everybody is being carried along, right? So that's that. Trying to see where is that question. No, seeing it. This question number 6. This is question number 6. Look at it. Fraud. Fraud is an intentional act by one person, by one or more person, involving the use of deception to gain an unjust or illegal advantage. The 2 types of fraud identified in National Standard on Auditing is fraudulent financial reporting, which is a deliberate misrepresentation, misstatement, or omission of financial statement data for the purpose of misleading the reader and creating a false impression on organization's financial position. Okay, this could be perpetrated through forging or altering of accounting records or supporting documentation which form the basis for the financial statement, or misrepresenting or intentionally omitting events or transactions from the what? From the financial statement, okay? Intentionally misapplying accounting principles. The fraudulent financial reporting normally involves management overrides of what control. They have reservation of assets. And say asset reservation is fraud that occurs when people who are entrusted to manage the asset organization steal from it. This could happen through embezzling receipts, okay, from the bank. That is, a salesrep pays money and you gave the customer, the sales rep gave the customer the sales rep money to transfer money into. Okay, that is what we mean by that. Then we have stealing physical assets, okay, such as inventory, stock, okay, or trade secret, which I explained that about Coca-Cola and Pepsi. All of these were discussed last time. The next one, causing an entity to pay for goods and services not received. For example, creation of fictitious supplier. So you just create a fictitious supplier that never existed. They're putting an entity's asset to personal use. I explained that of being given a car. Can I use the car for what? For Uber, boat, or in drive. Okay, procedures to perform by the auditor to identify risks of material misstatements due to fraud include making inquiries of management in respect to, you can see all of them there, making inquiries of management and others within the entity as to whether they have knowledge of any actual suspected or alleged fraud, and to obtain views about the risk of what fraud. Right. The next one, evaluate any unusual or unexpected relationship identified while performing analytical procedures, which might indicate a risk of what material fraud. Then next, evaluate information obtained from other risk assessment procedures to see if any fraud risk factors are present. Okay, review transactions with related parties to ascertain their nature and whether they have been carried out at arm's length. Okay. So there's another, I think there's the C part of this question. I think we didn't see it that time. It talks about, but let's go back and see that question C. The C part of that question, we didn't see it that time. Sorry, question 6. Okay, state 4 risk factors. Thank you. That's what I was looking at. I stated it. State 4 risk factors. Okay. State 4 risk factors. That's what I want us. Okay. We look at the risk factors. Okay. The need to meet the expectation of third parties. For example, this is trying to obtain additional finance. Okay. Management being remunerated through profit-oriented performance or results-related bonuses. I've explained all of that last time. Okay. The entity's profitability being under threat. Okay. So due to increased competition or rapid changes in technology, so they try to what? Beat the technology. Okay. The next one, the nature of the industry or the entities operations providing opportunities for fraud. For example, complex transactions or significant accounting estimates. Okay, and ineffective control environment. That's where you don't have a good internal control system in place, or you don't have the support of management. Okay, low morale among staff, or poor communication and or enforcement of ethical standard by management. Okay, then personal pressure on staff to misappropriate assets. For example, personal financial problem or threat to redundancy. Okay, so if there is an information that somebody might be relieved of his duty, okay, then the person could perpetrate fraud, all right, and he will not get notice until after he has left. Like what happened in First Bank. The fraud happened almost 3 or 4 years ago, okay, but they got to know not 3 or 4 years ago. The fraud happened around May or April last year, 2024. But the head of that department, of that department in the bank, had resigned like a month or two before it was detected. So that was what led to over 120 senior staff of First Bank in Nigeria being relieved of their job last year. Okay, that's a scenario. All right. Next one, opportunity to misappropriate assets. All right. For example, large amounts of cash held or possessed. So if you owe too much cash in the hands of someone, let's say the cashier always have at least 1 million naira in his vault every day. There's that temptation and there's no cash count. There's a temptation that person can use the money for other things. Okay. So if you look at, what you need to also realize is this: as you are reviewing these questions, you should also be looking at what the examiner's report. That is the pulse of the examiner while marking the what? The student answer booklet. Okay? This is talking about, this is the comment by the examiner. I said, the question is in 3 parts and test candidates on fraud provision of ISA 240. About 50% of candidates attempted it. Understanding displayed was below average, though the question is direct. Performance was considered below average. You can see how direct the question, they did not put any scenario there. It's just straightforward. And they said the performance was below average. Okay? So candidate commonness on doing was mix up of what solution? They mix up the solution. The candidates are advised to study well and answer questions in line with the examiner's requirement. Okay? This is where they score. Each type of fraud mentioned, guess what? 3 marks each. Okay? 1 mark for each procedure mentioned. You see what I'm saying? Maximum of what? 5. 1 mark for each fraud risk factor stated. Maximum of what? 4. That's at the end of what? The 15. Okay? So does anybody have any question, comment, observation? Any question?
Sir, please, can you forward the past question to the group chat?
Is there?
The
I'll forward it again.
questions.
Is there? It's on the group chat already. Okay? I will send it again, don't worry. I will send it again. All right? So that is that. So in the absence of any other question, I think I'll send it again. If there's any other question, we can call it a wrap for today. All right? But if I start another topic now, we might not be able to finish it now. The next one we're supposed to look at is what is audit evidence. So class, read it ahead. All right? Please try and read ahead. That when we are discussing it, there will be, we can all participate and we can flow together. All right? So thank you very much. Is there any question? Any comments? Any observation? Is there any question? Comment or observation? Are we good? Okay. Thank you so much for your time. All
Thank you,
right. Thank
sir.
you so much. All right. So all the best. Your exam is commencing on 9th of May. I hope you have
20th
seen
of May.
the advert. Huh?
20th, sir.
Is what?
20th.
Have you seen you've seen the timetable?
Yes.
I saw it today. Oh. Let me check it again to be sure. So I'm not going to be passing
Okay.
the wrong. Just hold on. Let me check it again. It won't
Okay,
take
sir.
time. I have it here. So that we all be on the same page. I saw it today and I marveled. I said, it can't be true. I saw 9th there. Let me just be sure what I saw. Okay, it's 20th. Okay, thank you. It's May 20th to May 23. To May 22, right? To May 22. That's the exam. All right. May
Yes, sir.
20th to May 22. All right. Thank you so much. So, all the best. So, we see again. Enjoy the rest of the week. Have a good night.
Nice, sir.
Good night, sir.
Thank you, sir. Good
Okay.
night.